Well, happily, we have found a time to have office hours once again with our good friend and colleague, Professor Mark Guthner of Rutgers, who actually is not in the office today. We'll explain why today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Office Hours with Professor Guthner, who is not in his university office today. Why is that, Mark? What happened?
Well, we're having our super cold spell over here, and we had a pipe burst in the building. So the rules of the school, I don't know what they are, but if you can't have running water, you can't be in the building. So I can't go and be in my office. So the tower where my office is a separate building from where the classrooms are. So I simply chose to stay at home so that I could do the podcast. Otherwise, we wouldn't be able to do it today. So, and given it's so cold out, I'm happy to, stay out in the cold and the nice.
So what happens? Do you give your lectures then remotely, or did you not have lectures today? How did that work?
No, we do those online with Zoom. So I think the Zoom account we work with can have several hundred participants if need be. But my class, the class I taught today was portfolio theory to graduate students, and I got about 30 of those, 25 of those folks. So they sit and listen, and I do record it so that just in case people miss it, they can do something else
Is
and
any of
watch
that
it later.
information? Are any of your lectures? I'm curious. Are any of them available publicly, or are any of them available publicly on a lagging basis? Because I've noticed that what is it called, Common Courseware or something like that. Sometimes when I have an interesting topic, I've been able to watch lectures with people like Blythe and so on at MIT. It's been kind of nice. Does any of your stuff end up publicly available, or will it be like in a couple of years?
No, I don't put it up. And in fact, the way the system works, it stays in the system for like 3 months or 6 months, something like that. And then it gets erased. And you can imagine why. There's thousands of people, millions of people using this. And that's a lot of memory. So because it gets stored inside of Zoom's system. And so it erases it after a period of time. I haven't been really excited about doing that. I think if I did that, I'd want something curated a little bit better instead of me speaking over a PowerPoint that are, things on the screen like we do here with our podcast.
So
and then a little
speaking
picture of me up in the corner talking. And then I think it has pictures of the students there potentially too. So
Yeah, I mean, I suppose there would obviously be some issues with that. You and I have not held one of these podcasts in several weeks because you were dealing with a new class schedule, and we had to make sure we could identify a time that was going to be mutually agreeable for us to do this.
yeah.
And what that means is that, we often talk about economic issues. We talk about both fiscal and monetary policy. And I don't think we've done one of these since Warsh was selected as sort of the lead candidate for the next chairman of the Federal Reserve. And I thought we might begin our conversation there. I guess my first question then for you is, how do you feel about that? About him being the potential nominee, which I don't think it's been formally presented, but he is the number one choice right now, I believe. Yeah,
He's an interesting choice. He's a guy that's been, I think, quiet with respect to having a public persona. The professionals kind of know who he is, but the general population doesn't. I did sit and listen to a long talk that he had, and it was because some crypto people were very excited about what he had to say about crypto, and he was, I would say, he was not negative, and that was a good thing. And they interpreted it as being very positive. But I liked what he had to say because he said it's like Bitcoin is like a data point out in the marketplace, like gold. that can provide feedback to whether or not the Fed is doing things correctly. I don't know if you remember when you were a young cub in the business, Wayne Angel, who was on the Federal Reserve Board. He was a very huge
Mm-hmm.
proponent of watching the rate of change in the price of gold and the level of the price of gold, um, as to whether or not the market was interpreting what the Fed was doing as being either too easy or too tight with monetary policy. I would rather they have additional data points besides inflation and labor. I'd like this real time idea that there are other things going on in the market that maybe they can detect themselves making a mistake. Um, um,
To that point, I actually have on my screen, I have Trueflation up. So, one of the things I think a lot of people might not understand about, some people have said, well, you meaning I have been, uh, highly critical of Fed policy since the GFC.
yeah.
For what it's worth, this is kind of an important point. Warsh actually worked at the Federal Reserve when Ben Bernanke was chairman. He had previously been working at the White House
Hmm.
before that. And so he was there during a highly tumultuous time, and he presided as a part of the decision-making process when they first initiated QE, and he was in support. And again, I'm going to be going by memory here, so people can look into this with a little bit more detail if they choose. But I believe that the first tranche of quantitative easing was $1 trillion. And I believe he was in support of it. And I believe the reason he was in support of it was because he felt it was the duty of the central bank to ensure the stability of the financial system, of the banking system more broadly. And things were breaking at that time. You and I both remember that commercial paper market had essentially completely fallen apart. The mechanisms for just the day-to-day operations of businesses in the economy were getting lost. Now, in some cases, there were other reasons for that. So General Electric was one of the companies that complained about because they relied heavily on the commercial paper market.
Yeah.
And so we were looking at the time at what I think a lot of people may have thought of as sort of one of the greatest companies in American history, General Electric. What a lot of people did not know was that there was probably some financial engineering that was going on inside, and the tide was going out in the GFC, and so we began to discover, over the ensuing period of time, that maybe particularly GE Finance, wasn't everything that it had previously been cracked up to be.
Yeah.
But he was in support of QE, and as my memory of those events is starting to fade, I'm going to say this, and you can correct me if I'm wrong, but I believe you were actually also in favor of the first batch of QE. I remember distinctly, and just you can tell me if I have the context right, but it was in one of your reports, because you did a lot of reports leading into the GFC when you were still at Bank of America.
Yeah.
And somewhere around I still have a lot of those. But you also were showing basically the growth in the money supply. They had a chart of it, I remember distinctly. And I remember that as the GFC unfolded, you had calculated a lot of the bad debt, and essentially how bad debt has, as it implodes, sucks in the money supply
Yeah.
precipitously. And your point was that such a fast sort of collapse in the money supply was probably disruptive. And that first batch of QE, I remember you had drawn a line, here's what happens to the money supply without it, here's what happens with it. And basically it created a mechanism of continuity to the growth in the money supply that predated the GFC. So effectively,
Oh,
it was
yeah.
an offset. I don't know if you remember that chart, but I remember I was like, oh, that's a really good way to display it. So would it be fair to say you were in support of that first bit of action?
I would say that was mildly supportive of it. I didn't really think in terms of support or against. I just thought this is what the government's going to do, and we got to figure out how to, manage our trading book around what we're doing. I was not really putting so much of a value judgment on what they're doing. And I knew it was coming and they were going to do it. I said, I remember talking to Mickey Levy, who was our chief economist at the time. And by the way, I think he's the best economist that retail doesn't know. I think it's just brilliant. But in any event, I said I was afraid that they were going to do multiple tranches of this, and that we're going to end up with a lot of inflation, and things like that, and that would cause other problems down the road. Yeah, they'll solve a short-term problem, they'll create a long-term problem, and that was my concern. And so yeah, I was not really against it for it. I was just like, it's coming, so let's just deal with it. Was sort of a little bit more my attitude
Hmm.
about it. So, I tend to be very much that the government and the Fed shouldn't be intervening so much. But, the Austrian business cycle theory says that, when you juice the money supply, you're going to create all kinds of bad investments, and then you're going to cause an implosion. And then the government's going to come in and print a crap load of money again to cover up the implosion. So, so that's how I think about,
It's a slippery
yeah,
slope,
you
in other
just keep
words.
doing it, and then you just kind of put out, you keep putting off into the future the day of reckoning. Um, and I also thought
So,
that they should have, when they did TARP and these other things, where I think it was the top 8 banks, were essentially were required to take $25 billion worth of preferred stock from the government. I
mhm.
just thought the government should have demanded a larger pound of flesh from the
They should have
industry
had
that they did.
they should have had convertible preferreds. They should have basically maintained some potential upside,
Yeah. Think about
or
what they
even
did to
meaningful.
Freddie and Fannie. They're still sucking money out of Freddie and Fannie. All
Hmm.
the profits from Freddie and Fannie right now, which is a huge amount of money. It's tens of billions, if not close to 100 billion a year. The Treasury is sweeping that money into the Treasury, as the cost of bailing them out during the great financial crisis. Now, I don't know that I would say they should go that far with the commercial banks, but just injecting a bunch of money and getting whatever it was, 6 or 8% coupon on that didn't seem like uh, it didn't seem like taxpayers got a fair deal there to me, to my way of thinking.
Yeah, I mean, I'm inclined to agree. I think that if we think about what they should have demanded to be the lender of last resort to a distressed institution, you could look to the actions of folks like Warren Buffett at Berkshire and what he demanded for the preferreds that he bought from Goldman at the time to capitalize them. Now, he didn't have unlimited upside, but he was senior in the cap structure, as of course the government, can and should be, and ultimately is, um, and got meaningful participation. So I think that's a fair it's a fair arrangement. I think it gets very difficult though, because how does that negotiation take place? Um, one of the things I think that's unfortunate is we've gotten ourselves into a point where we're essentially compelled, because of these too big to fail banks,
Yeah.
to deal with this, and that's kind of unfortunate. What I had on my screen, and the thing that I was bringing up here, so this is Trueflation.
Yeah.
Um, Trueflation is something that everybody can have access to. They have subscriptions. This number that I'm showing you right now, this 0.68%, that is Trueflation's essentially an adjusted real-time inflationary measure, and it's substantially lower than the government's reported rate. Now, I have often said that real inflation is higher than the published government rate, and Trueflation has too, but their reported numbers tend to be much more volatile. So, for example, during the 2021 to 2023 very high inflationary period, Trueflation's estimate of inflation was much higher than the published number from the government, which I think peaked out at 9.1%
Yeah.
on CPI, and probably was much closer to what people felt. So, what I was just going to mention about this in the context of Warsh as the potential next chairman of the Federal Reserve is that he has specifically suggested that he doesn't believe that the aggressive use of the Fed's balance sheet and all of the quantitative easing that took place after that first trillion was appropriate, that it was either needed or appropriate. In fact, he thought it was a very bad idea. But by pointing this out, that a Fed that was willing to pare the balance sheet but also lowered the front end of the curve, that would be consistent with some of the more recent inflation data that we've seen. Wouldn't you say?
Yeah, I think that's right. I do agree that inflation, at least the reported numbers, are coming down from the peak that they had. And as you said, I don't think the government reported numbers as high as what really took place during that time period. And I think that's why there's so many people online. I see a million YouTube videos of people saying that, I can't cover my bills anymore. Uh,
Mm.
and uh, and it's
Although you could have inflation of zero and people may not be able to pay for their bills because the prior inflation elevated prices. In other words, if you have 30% inflation for any length of
yeah.
time and then zero, prices are still 30% higher than they were at the beginning of the measuring period.
Oh,
So, yeah, if you had a cushion of 10% at T1, you have 30% inflation, you've had no meaningful increase in your income,
mhm.
you could be 20% underwater even if inflation is now zero, right?
Yeah. And and the inflation effects are cumulative because we had not just that peak year, but we had a lot of 3 years of very high inflation. I think over that lockdown period, price level jumped what, 20 or 25% in total over that
I
four
think it's
years,
30.
30. So
Mm-hmm.
um, I don't know anybody other than the uh, employees at UPS and Ford Motor that got wage increases of something that reflected that magnitude. The average person did not. I can tell you as a professor at Rutgers, mine went up at about 2.75% every year for the past 3 years. And that first year, there was no adjustment, you know, at all,
Mm-hmm.
because it's like, okay, the world's in turmoil. And so we're going to freeze wages. There won't be any wage increases. And I go like, that's fine. It is what it is. And then after that, the wages they started adjusting at 2.75%. But I had a terrible experience because my landlord sold the building. I was living in a building built by a builder, and he had run the place for a long time, and I'd lived there for a long time. Knew him very well. He sold the building during the lockdown, the complex. And then the new landlord came in and demanded a 65% increase
Mm.
in my rent. And so I remember I had to pack up and leave on the last day of the year when in a snowstorm. The
Ugh.
person that bought the building was very litigious, and so they were said they were going to sue me if and they were brutal. They whacked everybody in the complex. And I wanted to fight them. I had a lawyer that said, you can win this because your contract says they can only raise your rates year to year at some level that's reasonable. Says there's no judge that's going to say 65% is reasonable.
Mm.
But we found a new place that we really liked, and we liked the. It's sort of like a little bit like living in the city, but living in the burbs at the same time. So we can walk out of our building and walk to dinner, walk to a Dunkin' Donuts, walk to a grocery store, walk to a park. all that kind of stuff. So it's a nice location, a brand new building too, by the way. So we just decided not to fight the tape.
which which you heat with mining machines, right?
Yeah, so that's very interesting. During this cold spin here, I have not had to run my heater except for in the last this entire winter. I think I only ran it 2 days, and it's been enough. This building is much more efficient than my old building. My old building was 2x4s, insulated 2x4s with sheetrock. Not very efficient building, even though it was brand new when we moved in 15 years ago. This building is concrete and steel, so it is very energy efficient and very comfortable.
How many miners do you run, by the way?
I right now I have um,
Is
I
that the hum I hear in the
yeah,
background?
that's a little one. I turned it down. So it's doing about 3 terahashes right now, and then I have two others that do 10 terahashes, and then my other one that's behind me does 10 terahashes, but it broke and I sent it back for repair. Something happened. I wasn't, of course, running it during the summer, and um, so um, when I tried to run it when it got cold, it didn't start up. So I don't know, I gotta do something. I get it back up and running. I don't know if it needs a new firmware or something, but anyway, I don't need it. I'm very comfortable where we're at here now. I think that's the way of the future. We're gonna heat hot tubs with Bitcoin miners. We'll heat our homes with Bitcoin miners. And
What are you mining there, by the way?
oh
Because obviously Bitcoin has come in quite a
yeah,
lot.
it's just
Um,
Bitcoin.
oh,
I'm
okay.
a Bitcoin maximalist. I had one running Litecoin and Doge, and it was a merge miner, so it was running mining more than one thing at a time. And it just passed away too. I don't really understand why the hardware dies because I don't drive them hard. And the real problem is nobody stands behind their products. I don't want to say who I bought it from, but it's just very disappointing. Oh, the warranty is only 6 months, so you're out of luck. Can we sell you
Did
another
you
one?
model?
And there's
Did
nobody
you
around
model
here to
by?
repair them. So
This seems like the kind of thing you might do, but I realize you're exceptionally busy. I'm curious. Have you calculated what the net cost of running them is, considering their heat generation?
oh yeah, so the way I think about it is my cost is just the cost of the unit. For me, the I don't include, and it's not appropriate to include the electricity cost anyway, right? So it's either the miners are going to use the electricity, or my space heater, or not space heater, but my furnace is electric
Mm-hmm.
furnace here is going to use that electricity. It's getting one way or the other. So I've probably earned back the cost of the hardware at this stage of the game. So I'm probably near the point where after like 3 years where I would be net better off.
Because I think right now the lowest cost miners right now. So I'm talking about X amortization, depreciation, and all that. So not including the investment in the machines, but just an OpEx for the lowest cost miners. Because for you, heat is a benefit.
Yeah.
For them, it's actually another net expense
Yeah.
because they actually have to keep the machines cool. So it's kind of interesting to me that normally, when we think about a business, businesses have an advantage of scale. But in this particular instance, actually, small miners like yourself actually have a benefit because the heat isn't something you have to deal with. It's something you otherwise would be generating
Yeah.
at cost anyhow.
Right.
So it's kind of a curious thing. So for those of you out there who are saying, if the big mining companies, if their marginal operating expense, excluding the machines, is about $75,000 per Bitcoin
Mhm.
at the current cost of electricity, how could I ever possibly expect to run a machine and have it work in my favor? Well, the answer is that when these machines run, they generate heat. If you have a big server farm, you don't like heat, so you then have to use more electricity or operated either in a very cold place or use more electricity to keep those machines cool. Whereas in your case, individuals who live in cold areas, I don't need a lot of heat because I'm in California, but you do because you're in the Northeast and it's whatever 0.
Hmm.
That's kind of interesting. So we have some questions here. Maybe we can move on from our just general
Yeah.
conversation. The first one comes from Sicilian Ambassador, who says, "Hi guys, when the RSI reaches 70 on the SPX, I like to sell 2 calls and buy 1 put so I can keep some premium. Is buying a put a waste of money? By the way, I like SPX over SPY for many reasons. Thanks." Any thoughts about that?
Um, well, I'm always nervous about naked shorts. So did I understand that he's just selling a couple of naked short calls?
Yeah, I think he's selling. He did not. So Sicilian, if you are watching at the moment, you want to just provide us with some detail. I'm assuming you are not long SPX per se, but I'm also assuming that you are net long equities.
Okay, because
So if you're selling SPX calls against a long equity portfolio, I don't see anything wrong with that
yeah,
necessarily. These are cash settled. By the way, I also like SPX over SPY. The reason I like them is that they're European. They are cash settled. I
yeah,
think that's a benefit. Both SPX and SPY, I know SPX, but I believe SPY also have a favorable tax treatment in some contexts.
okay,
So they are subject to the mixed straddles long short capital gains rules.
yeah,
But I typically have used SPX options myself because you make your bet, and then when the option expires, there's a net debit or a net credit, and that's it. There's nothing else to think
yeah,
about. And I have seen circumstances in the past where an unwitting assignment or exercise has resulted in some very bad outcomes.
yeah. So
So,
I would agree with you there. If he's long some underlying equities, and they don't necessarily has to be the S&P 500, but
mhm.
some diversified portfolio of equities, then he's somewhat covered but if he's just saying I have cash and I'm short calls and I would not be too excited about that simply because the RSI gets over 70. It can hang there for a long time as the market continues to chug higher. But if these are covered positions, then I think that's a pretty good strategy.
Yeah, actually, to that end, I was going to show that this is kind of interesting with respect to RSI. Look right here at what I'm showing. So
Hmm.
a higher RSI. So there's 2 ways that people use relative strength uh, in a technical perspective that I'm familiar with. Mark, please jump in if you have some others that are also informative. So one of these is that one looks for relative strength in an industry, a sector, a stock, to see whether, for example, now it might be a good time to get into it. In other words, if the relative strength of a security or a group of securities improves on a relative basis, that could be an indication that that could be a group that's set to outperform. We actually just talked about this on an earlier live stream where I showed how I monitor the relative performance of various sectors to each other and to the broad market, large caps versus small. Examples would be energy, materials have materially outperformed since the beginning of December. Small caps have materially outperformed. So relative strength can be a positive. It's also used as a contrarian indicator. Some folks, let's see if I can find an example. Let's see if we can find a stock that has really done well today and see if it has a super high RSI. Some people use it as a contrarian indicator. That is to say, and I think this is what Sicilian Ambassador might be alluding to, is that some people say, well, when the RSI gets to above 70, that indicates in the near term that that instrument, that security, that asset might be overbought, as they say,
Yeah.
right? So my concern about that is that to your point, number one, something can remain overbought for some period of time. This down here, I don't know if everybody can see this chart right here in the lower
Mhm.
left. Can I? Let me see if I can expand this. See if I can expand this thing. I'm going to try to make this a little bigger. Or I can maybe do something like this. So this lower left-hand corner, we're going to try to make this a little bigger. Am I making it bigger? I don't know if I am. So I think we can kind of tell.
Yeah.
So the top quintile. So these are the stocks within the index that have the highest RSIs, outperform over the subsequent 30 days by quite a lot. So the most underperforming stocks, the weakest stocks, actually have a 30-day forward-looking return
Yeah.
of minus 12 basis points. And the highest ones actually have 174 basis points. And another way to look at this is to say that if you got long the highest RSI stocks in the universe, that's in white, and short the weakest ones, that's in yellow, the outperformance is substantial. In fact, it's 23.5% over the course of the last year, top RSI outperforming the bottom. So that's meaningful. And it wins about 2 months out of 3. That's about
That's
the
pretty
net
good.
effect.
What I would think it might be an interesting strategy is it goes above 70 and you patiently wait for it to break below 70 to tell you that maybe a turn is at hand. And that might be
Yeah.
something worth studying, um, because as things
So,
start to trend, and one of the things that I've noticed more in the last 10, let's say since the great financial crisis, it seems to me stocks trend more than they did in the past. And maybe it's because the
mm-hmm.
Fed just prints lots of money. I don't know, but it just seems like stocks trend more and they go higher than people think. And if we go look at the old Buffett indicator, what are we, about 250 now on that? So up in nosebleed territories where stocks have never traded up at these levels before.
Mm-hmm.
Um, and sort of saying that stocks are going up more and more. I did.
So to answer Cecilian's question, then I guess what you were saying is if it goes over 70, it's now flashing yellow.
Yeah.
And then you're looking for confirmation that it's starting to break. So that could either be that it dips back below 70, or would you say using a shorter term moving average, like the 50, would be
You could.
something like that?
That could be a way to confirm, but that's the way I would test. I wouldn't. You're going to do a lot fewer trades, right? Because the
Mm-hmm.
thing is going to be up there, and if it goes for a long time, it's going to keep you out of a bad trade. You maybe give up some of your upside because you're not getting the extreme. You're not selling the extreme, but you're probably reducing your risk on the trade a fair amount.
Mm-hmm.
Um,
So I would also add that if someone is interested in using shorter term technical indicators, there are some that, over some periods of time have shown that they have some
How do
edge.
you, what's
Um,
the Bloomberg command to pull up these pages?
so this one is BTST,
Okay,
so back test. So this is basically a back test
okay.
of various technical
Yeah.
indicators. And what we can see, and this one actually is catching both a bull and a bear market because this goes through 2022.
Mhm.
If we just go back, let's say 3 years, so we were basically in a bull market. Maybe it's probably helpful at times to identify that. Something like an exponential moving average or a weighted moving average is not a bad way to think about technical entry and exit points. So I would say that I like SPX. I like the idea that you are looking to sell premium, because if you buy premium all the time, that's a problem. With respect to puts on SPX, I would offer the following. Consider using put spreads if you're going to use an index rather than just outright puts, because you can reduce the cost quite significantly due to skew. That is
Yeah.
to say that the downside puts have a much higher implied volatility than the at the money or just out of the money. So you can reduce the cost. And the truth is, if you're looking at an index, indices don't typically collapse unless there's a really important exogenous event. The GFC would be an example of this. The pandemic would be an example of this. But just consider 2022, which was the closest thing to a bear market. We actually reached an intraday bear market in the S&P that year.
Yeah.
But it didn't happen instantaneously. So it's probably better to consider the use of put spreads if you're using an index to make your downside bets. So, Cecilian, I hope that helps you.
Yeah.
Finwest says, aloha, Mark and Mike. Good to see you guys. Likewise,
Aloha.
he says he's in Hawaii, I assume. It's chilly. We'll only reach 78 degrees today. So that makes it, well, that's a lot warmer than it is where I am, because I think we're probably going to top out in the low 60s, I'm guessing. I heard my HVAC heating, and the heat only trips if it gets below 65 degrees.
Oh,
So
okay.
it must be below 65 outside right now for us. But I don't feel sorry for me. I'm not on the East Coast.
Yeah.
So Finway says, not too feasible to run such machines here. The weather's too warm. Yeah, that's right. He's in Honolulu.
Yeah.
Yeah.
No, it doesn't work in those places for sure. It's people that live in places like California and other warm places. They potentially can spend a lot on air conditioning during 6 months out of the year or whatever. Especially if you're in Southern California. You're in Northern, so that's cooler.
Yeah.
So you don't have these extremes, but yeah, here we can get some really cold. And so you think about the heat a lot. And in fact, my office is so bloody cold because I'm on a bridge that's between two buildings. I got a building here and a building here, and I'm on a bridge. So air passes above and below me. And so my office is.
So your office is suspended
Yeah.
in
So it's
space?
colder than I'll get out in times like this. And so it's the Bitcoin miner I have running in my office keeps me warm. And actually I need additional because it's been so cold. I'm still cold in my office. I was running 10 terahashes in there, which is like, I don't know, 350 watts, something like that. But it runs 24 365, and I had to drop another one in there. I was running a Litecoin miner in that office, and it passed away. So
So Sicilian did follow up, by the way. He did point out that he is long a lot of S&P 500 equities.
Oh, okay,
so,
then he's fine.
Yeah. My only suggestion would be consider the use of put spreads, and I like that. I like that strategy in that case. So the next question, and I think this is a good one, and he mentions several stocks specifically, at least one of which I know you had recommended some time ago on the Options Edge, which was Corning, I believe. In any case, he's saying, I've been doing this lately on some names that I'm short. So he's doing covered puts. I've been doing this lately on some names I'm short. So he's short Celestica. He's got ALB here. So you must have just shorted this because that was actually a name that I had recommended a while back last year, and obviously it's been on quite a tear, but I actually haven't updated that recommendation. I think I brought it up on this. Not this live stream, but the open mic one, as a potential long bet.
All right. Do they still have their lithium business? Is that why it's run up? I thought they sold their lithium business, and so that's why I'm a little confused. But I could be thinking of somebody else.
You know what? Actually, this is interesting. So Jim Howard brought this up. He said, you should bring up on these live streams, bring up a large language model and see what they have to say. and actually even see what a couple different ones have to say,
Yeah.
maybe. And I have paid versions to almost all of these. So I think this is logging in. Is this logging into the paid version? I think so. So we could even ask and see, our lithium business. We can actually look on Bloomberg too, but I'm curious to see how the large language models answer the question. So their corporate actions is right over here.
Divestiture. Okay.
I'm looking for divestitures. And that was right here. So we can see what they've got to say.
That was something I thought they sold a year ago or split off as a, but I don't remember. And I
So that
I
was
could have been thinking of
Ketgen.
somebody else. What did they say? No.
And they're new.
Still has, okay, so.
They've done the opposite.
Oh.
They have been selling off their non-core businesses to double down on lithium.
Okay. All right.
So that would be according to that one. And yeah, so what now this is where it gets interesting. So
See if somebody disagrees.
Yeah, let's see whether what chat's got to say about that. I'll put that in there and we'll see what this one's got to say. That'll be a little bit curious.
No.
So well,
they said no.
Grok says no.
All right, no. Okay.
Chat says no. So apparently the answer is no. What the company that is selling off a business or is trying to monetize
FMC. That's the name. FMC sold
okay.
the lithium business. Yep.
All right. So I guess his broader question is, if you are short stocks, what about doing cash covered short puts? Now, a lot of people are familiar with covered calls. A covered call, you own the underlying stock, you sell an upside call to generate some additional premium. So you're generally in favor of the underlying asset. Otherwise, you wouldn't own the stock.
Yeah.
And you're looking to collect a little extra premium, so you sell some upside calls. People are also very familiar with cash covered puts. What's a cash covered put? That's when you don't have any position in the underlying security, but you sell a put where you have set aside sufficient capital to purchase the stock at the strike price less the premium collected.
Yeah.
And the payoff profile is a lot like a buy right, buying the stock, selling covered call.
Yeah.
What our viewer here is actually saying, though, is he is short stocks and then he is selling downside puts. So kind of like the inverse of a covered call. And I guess the question is, do we like those types of strategies? So first I'm going to let you answer that question. And then I think it'll be interesting to actually look at some examples and give people a sense of what that actually looks like. And we'll use the stocks he's got.
Well, I think it's a reasonable strategy if you're short and you're looking for the stock to go down. But most stocks, the only problem I see with that is that stocks go up the escalator and down the elevator. So you're more likely to see a crash in a single stock, not in an index, but in a single stock. So from that standpoint, I don't like the strategy because you're limiting your upside. On the other hand, the skew gives you a higher, a bigger premium, right?
Mm-hmm.
So maybe you're getting offset there. But if you're unsure about the timing and you think a stock is rolling over and probably going to trade down, I think it's a perfectly legitimate strategy to employ.
Yeah, so I will offer the following. What might be my reasons for being in support of this? And my reason for being in support of this is that, first of all, good for you being short stocks. I'm always impressed by people who are short stock pickers because I'm not really.
Very hard.
It's immensely difficult. I've always been impressed by Jim Chanos. Anybody who can make a career shorting stocks, they're just cut from different cloth because one of the things about that is that stocks generally rise, and sufficiently capitalized businesses often, they can mismanage, underperform, do a lot of things wrong for a while. But eventually, a board of directors, assuming that they haven't gone out of business, might say, you know what, let's get some management in here who can actually figure this out.
Mm-hmm.
And managers are generally provided with incentives to improve their work. So the benefit of doing a strategy like this is that you get a standstill rate of return.
Yeah.
So if stocks generally go up, and they do, if you're selling puts, you can actually get a little bit of a tailwind in the form of decay. There's another thing, which is that if you're short stocks, presumably you want to cover at some point, right?
Yeah.
At some point, you're going to say it's come in enough. And if you can balance the time to expiration and the strikes you select, and can find, circumstances where it might make sense to cover, then that also can be helpful. One final point, which is that when you buy a stock can, in theory, go to infinity.
Yeah.
Whereas for most stocks, unless they're really a broken business, they're going to go out of business would be an example. But for most stocks, there will probably be some level at which they become interesting to somebody. And so they could go to zero, but that's as low as they can go. And so I feel like if you are comfortable with the idea of selling covered calls, then you are already comfortable with the notion of selling puts. And if you're comfortable with selling stocks short, which this viewer clearly is, that's a more sophisticated approach. You, like I said, are in a rarer breed of investor.
Mm-hmm.
I think that's totally fine. The thing I would say is that beware of catalysts. So, and what I mean by that is, let's say you have a business that you are concerned about, and I'm not trying to pick on any business. It happens to be a stock that I was looking at recently, and I know people that I respect immensely actually are in favor of this stock. So I'm just going to put this in. What happened here? IREN. Oh, whoops! I've got to go to the storm.
OI charting. Okay, I haven't.
Yeah,
I haven't.
This is our.
Oh, that's our.
This is our own system. This is our system.
Okay.
Yeah.
All right.
It's because we're able to display things that most charting applications can't.
Okay.
So IREN, and I know plenty of people who actually are, this is an AI trade. They run data centers. They're based in Australia. They announced earnings recently. As you can see here, the stock rolled over pretty precipitously. Okay,
Mm-hmm.
so they were accelerating an earnings announcement, and a lot of people thought that was going to be good news, and so in consequence, the stock had caught a bit of a bid in here. If you are short a stock, let's say you had been short this one, beware of special situations like an unexpected upcoming event.
Mm-hmm.
Like if they have an earnings result and they pull that forward, that could be something that could move the market quite precipitously. Yeah. That might be a circumstance where you'd say, maybe I'm going to wait and see what happens.
Mm-hmm.
I feel like the covered short put is essentially a way to mitigate the headwinds that short positions typically have, which is that stocks appreciate.
Yeah.
Other stocks that he has, by the way, gotten short. You can tell me what you think of some of these. Albemarle, which we just talked about, and that's had quite a run. I need to review that.
Corning, I do want to add one thing, and that is capital market theory. Capital market theory suggests that all assets are priced at a level that the market believes will provide a reasonable risk-adjusted rate of return. All right. So, because if the stock's trading at $50 and the average market participant thought the rate of return was going to be negative, the natural thing to do would be to sell the stock. That drives the price down to such a level that there's somebody willing to step in and says, yeah, I think at this price, at 35 bucks, yeah, I'm going to make 10 or 12% per year for the next, umpteen years. So
Mm-hmm.
that's a core tenet of capital market theory. Can I share a chart?
Sure.
Let's see.
I will stop. I'll hit stop share,
Okay,
and you
I'm going to do a
jump in there.
share. Um,
Oh, sorry. I just was told by the producer I don't do that, so I'm going to bring mine back up.
okay, you can do that.
Keep sharing.
Yeah, keep sharing. Yeah. So this is interesting. You want me to get out?
Okay. Okay. No, no.
Okay.
Okay. So,
Okay.
all right. So go ahead. What are we going to be talking about, Mark? What are you going to be showing
Okay. So
us?
I'm okay, let's go share this. I just made this chart for my asset pricing class, and because I was going to talk about valuation and returns on the S&P 500. And what I did here is I took SPX going back to 1980. That's as far back as I could go, and I divided it by M2. And what I thought was
Mm-hmm.
really interesting is the from 1980 to 2000, stocks went up more than
For
the
those
money
that don't
supply.
know, could you just tell them? Yeah. Okay.
And then for the next 9 years, it stocks went down a lot, and money supply went up much faster than stocks did. Remember, that was a pretty good time period from, let's say, 2003 or two. That's when the Nasdaq finally bottomed, and we had a decent run into the great financial crisis. So it
Mm-hmm.
massively underperformed. And then since then, stocks have been going up much more. But what I thought was interesting about this, because what I wanted to do was talk about, what drives share prices. And if we look at from 1980 to 2026 there, the average compounded rate of return is about 2.6%. So which I thought was interesting, so that if you think about over that time period, real GDP grew about 2.6%. So, does this mean, this was the question I was posing to myself, over super long periods of time, should the S&P 500 go up by the rate of the money supply plus real GDP? It just kind of like by accident, it sat there. Now, if I took, this is what got me started on this, I had data, live data, daily data, or monthly data and actual numbers. I could only do the chart here. I didn't have the numbers going back further. But I did have numbers from 2009, and that time period, the rate of return on the S&P 500 was a little less than 10%. Um, Money supply compounded at 5.3%, GDP compounded at 2.8%, and productivity compounded at about 1.5 or 1.5%. So that kind of was a way to explain what share prices do. Because in the back of my mind, that's kind of how I think about how stocks should do. Okay, stocks are going to keep up with inflation, so that's M2. They're going to grow a bit because they're going to grow with the economy. So it seems like, okay, real GDP is a reasonable factor. And then margins should improve with respect to
Productivity
productivity.
improvements.
And
Mm-hmm.
so I've been looking for things that kind of help predict what rates of return might look like over um, 5+ years. This number is I started to play with the data on a yearly basis, and it's very noisy, and so I wouldn't use it to predict over the short term what equity prices might do, the indexes might do. But I thought it was an interesting thought. But also getting to your point, if money supply is constantly growing, then we should expect share prices to constantly grow too. So you're kind of fighting the inflation, the asset inflation thing when you're short selling stocks.
Yeah, it's interesting that you mentioned that. I will say, I mean, anybody who watches the live streams that I've done for any length of time will know that as a part of my screening criteria for stocks on the long side, a base case requirement that I have is that their nominal revenues should be growing at least as fast as GDP or inflation, whichever is greater. And the rationale that
Nominal GDP or real?
nominal,
Okay.
at least as fast as nominal GDP
Okay.
or inflation, whichever is higher.
Uh-huh.
And my rationale for this is that if it is not, that means that it is shrinking
Yeah.
in real
Yeah.
terms. And there would be no reason. Part of the rationale there is that let's assume that I do something, and for whatever reason, I am not able to undo it.
Mm-hmm.
Right. That is to say, it's very tempting to say, oh my goodness, here's a company that's trading at 9 times earnings, and surely it's got to be worth more than 9 times earnings. And I can discount it back, and I can say even if the company is going to go out of business and their earnings are going to dwindle over the course of time, that if I discount that back, that the net present value is certainly greater than what what is being implied right now. So I should therefore buy the shares. But the problem with that is that maybe that's true, and maybe indeed the stock will trade higher in the short term to accommodate that difference. But if ultimately the company is shrinking and that its terminal value is zero, let's just say that you're in the buggy whip business and you don't have a mechanism to get out of it. You forget, you threw it into an IRA and you wake up 30 years later and you're like, what is this thing? It doesn't even exist anymore. If you eliminate companies that are shrinking in real terms, and I also look for the requirement that the earnings are growing faster than revenues, because I don't know whether any given business is going to see productivity improvements.
Mm-hmm.
Margins could expand because of productivity improvements. Margins could expand because demand for their goods is outstripping supply. There are a lot of reasons why margins could expand. So I want to see expanding margins and top line growth that are at least as good as nominal GDP or inflation, whichever is higher. Because then I know I've got a growing business in a solid place. Then I can start to think about multiples. Do you think that's a reasonable sort of starting point?
Yeah, I think that's a very good way to use the filters to go find
Yeah.
some names to go investigate. No, I think that's quite reasonable.
Yeah. Yogi Underwood 9851 asks the question, so what is the cost during the summer months? I would imagine you do not run your miners in winter only.
No, I don't run them in the summer.
Oh, you just don't run
No,
them?
if I have to run the air conditioning, I should say, I won't run them. So if I can run them and then just keep the windows open, I might keep them running because I don't need the heat at that stage. So I'm not really getting the freebie. I'm kind of burning electricity. I'm doing that balance. Am I getting more coins than I'm getting electricity? And so I typically don't run them unless I don't need the heat, for that reason. So
we should build a switch that turns these things on and off with your thermostat. So the minute that it would automatically trigger the air conditioning, it shuts those things.
Yeah, well, that would be one way to do it. So what I'm saying is, if there's air conditioning, I definitely don't run it. I'm not going to do one and the other.
Yeah, because that's like running the AC with the windows open.
Yeah, but maybe I might run them with the windows open because, well, I'm burning the electricity to run the air conditioner. I don't want to do that. So I typically, when I don't need the heat anymore, I don't. I turn them off and do their thing. It's just I like to use them for heat, and I got a couple of little things. They're called HeatBit is the name of the company in Delaware, Dover, Delaware. They make some clever products. They're not bad looking space heaters. So I have one in Wyatt's room and I have one in my bedroom. And so they're quiet. They kick out heat. If it gets too hot, turn them off, which they typically don't in this weather. And then I have, that's a little industrial thing. that's sort of like a toy. I think you're really that's connected to a pool. And I think if you're really supposed to be a daring player, you should be mining by yourself, lottery mining. So that
Mm,
if in, the expectation is you don't get you don't hit a block and don't make something. But if by accident you win the game and you get to process a block, you get 3 1/8 or 3 1/4 Bitcoin in one go. So
mm-hmm.
it's like that'd be like a casino lottery or lottery, lottery mining. But I just do it as doing. I see. I did a lot of this just to learn how these things work, so I could teach it, talk about it, and teach it in class, in my
Mm-hmm.
digital assets class. That I gotta figure out how to do it, and I'm gonna have to learn a lot more, especially how to rip data off the blockchain. So, which is something I'll probably
This,
teach myself to do this summer.
what do we think about Bitcoin here? Finwest is asking if you're writing any books. I know you've written a couple.
Yeah. Uh,
Are you in the process
yeah.
of working on anything
Yeah,
else?
I've written 2 tries at a Bitcoin book. And the first one I wrote, I sat it down, I started to talk to some publishers, and then I went back and reread it, and I said, "This is awful. This is awful." So I just said I have to start all over again. I mean, it's just after you kind of get away, you get buried in doing what you're doing. And then so I rewrote it, and what I wrote the second time is better. And I think what I'm going to do is I think I'm going to write something that I could use as a textbook. That would
Mm.
be still be okay for a layperson to read, just to learn about the whole deal. And I've started to spend a lot more time on the various pricing models like power law, Metcalfe's law, and things like that. Different methods of pricing Bitcoins. I'm very disappointed or unsatisfied is a better word with the models that are out there because they all kind of focus on supply and not really the intersection of supply and demand. So I've been thinking really hard about that, because if Metcalfe laws worked and the power law worked,
What is a Metcalfe law?
Metcalfe's law is a way of valuing a network. So it's
Mm-hmm.
why Facebook is worth $1 trillion, even though its assets are, $50 billion worth of computers or something, software or whatever. Maybe not even that, 25. And it basically says that the value of the network is equal to essentially to the square of the number of users of the network divided by 2. Yeah. So that's what it is
Mm-hmm.
for large networks. And so the idea here is that if you add one user to the network, that one person adds a lot of incremental value to the network because now he's connected to a billion other people. So it's the number of connections that matter. So as you
Mm-hmm.
add people to your network, essentially the cost of your network goes up linearly. The value of the network goes up by the square of the number of users. So those diverge really fast when you get to big numbers, and that's the way to think about valuing any of these social media companies, because it has to do with the number of people and then how their ability to monetize that, of course. But that's how they're turning nodes or connections into money.
I noticed that I have on my screen right now the price of Bitcoin with some fibs on it, incidentally.
You can share that if you like.
Yeah, I think it's up here. I'm going to throw two additional lines on here
Okay.
that I've sort of been keeping an eye
Let's see
on.
if I can fix that. You're just in
So
a small box on my machine.
yeah, so maybe I should see all those. I'm gonna do one other thing. I'm gonna get rid of these grid lines because they're just making things a little too noisy. So I apologize because the numbers are small. I did not realize that so we had a brief moment when Bitcoin hit almost 60,000 on the number
Yeah.
back here on the 6th. And I've been looking at this chart now for a couple of days thinking, I must have missed that. I didn't realize it had gotten quite that low. Very close to this 5-year Fibonacci retracement.
Okay.
Very close, as it happens, to this 200-week moving average. If you're seeing 1,400 on the screen, that's just because I'm converting trading days
Yeah.
to the weeks. So that's on a calendar basis. And that seemed like a reasonable level for some longer term support. Do you think that having, well, it didn't quite hit it. So as our friend Carter Worth would say, he loves to see it when things go right to the
To the
penny.
penny.
But do you,
Yeah.
yes, to the penny, to the penny. But I guess the question I would have for you, you've been watching this, you've been involved with this for some time. Do you think that maybe the worst of this decline is now over? Or do you think that we could violate that 200-week moving average? That has historically been a decent
Yeah.
time and place to buy.
My thought on this is we could trade in a big range, like down here at 60 on the low end and 120 on the high end, or maybe 100 or on the high end for a year or two. And then the next move higher takes place. I am contrarian bullish on the upside because that fear greed index for Bitcoin, I think, is still trading at single digits, and so people are scared. I think what's happened is there's been a lot of forced liquidations. The people that will, buy the Bitcoin perpetuals, which is a futures contract. Some of these exchanges will let them lever up 20 to 1 or even higher. And so it doesn't take a lot to get blown out. And if you remember, the last big sell-off that came on a weekend, right? So if somebody wants to take a rate at your Bitcoin, you trade when trading is going to be thin, right? It doesn't take that much to whack it, knock the price down, kick a few of these margin calls, it gaps down, and then you go sweep up.
How about strategy? What do you think of formerly known as MicroStrategy?
Strategy. They're okay. I think they're priced somewhat close to their price of their underlying Bitcoin. And so I think the premium has certainly come out of it that was there. And that premium was there, I think, because there was a lot of people that wanted to own Bitcoin but couldn't because for various legal reasons, or they didn't have the authority to do it with their investment guidelines. But they could buy stocks. So they'd buy a stock that was representative. And I think that's the principal reason why the price of MicroStrategy way outperformed Bitcoin on the way up, and of course underperformed on the way down as that came off. I think what Michael Saylor and MicroStrategy is doing with their preferreds are very interesting because they're now giving people a way to have exposure to Bitcoin with different levels of volatility. You could have a MicroStrategy, which going forward will be more volatile than Bitcoin. They've got essentially a short duration preferred that has a variable coupon. So that's the other end of the extreme. And then they have a convertible. Now the convert is a busted convert at this stage of the game because the conversion rate is $1,000 a share on MicroStrategy. So it is like wicked out of the money.
Yeah, they have several. I think they have 5 converts.
Yeah.
But I mean, the strikes are substantially out of the money, and I keep pointing out to folks who are looking at the stock that if you're fully diluting the value of the underpinning crypto holdings, you need to understand that actually you're not giving away much of that as a shareholder until the shares have appreciated materially. Like one of the strikes is $630 a share. The stock's trading $135 right now. So you have a huge amount of upside you should hope, if you are a shareholder,
Yeah,
that you have to contend with
it gets
the
taken
Kindred
away at
strikes.
those. Yeah.
Yeah, and maybe that's a good place for us to end this one. And I realize, for those of you watching, which we both appreciate tremendously, that Mark was going to be in his office. We had some other things planned, and then pipes freeze, and suddenly he's in his house and doing something very different. But it's been great to have this conversation with you, and hopefully we can do it again next week. For those of you who joined us, we appreciate your time and attention. Give us a like, a subscribe, and you can check out the Options Edge for some of the things that Mark is writing on that side. And hopefully we'll get to do one of these next week, and you can tune in, assuming everybody's schedule is amenable to it. And put us some comments into this video. We will look at those. And, if you put the comments in soon, like before the end of this week, we may even have the opportunity to put some of those questions into ideas. Not the live stream chat, but into the comment section for this video. Put your questions in there, because the live chat actually disappears. Then we can look at those, and maybe we can even have a sort of a more structured conversation for office hours next week.
Okay.
So to all of you, thank you, Mark, and thank all of you for watching.
Thank you, Mike.